Good morning, everyone. Welcome back to Business Law 2. Today we're going to be looking at Chapter 44, which involves the legal aspects of corporate finance. Some of the overall learning objectives that are kind of like a takeaway for this chapter is to understand some general sources of corporate funds. We'll be looking at some basics of corporate bonds and other debt leveraging tools that corporations have at their disposal, as well as looking at the various types of stocks that exist and some issues pertaining to initial public offerings. So that's going to be the overall focus for our examination of this chapter today. In terms of corporate funding sources, there's some broad categories that the author discusses in this chapter. So the first thing is what's called plowback. And this is essentially where you're reinvesting earnings back into the corporation. Depending on the corporation, some corporations have a history of just, as they have profitable results, on a quarter by quarter basis, they kind of just literally put them back into the company in order to expand operations or maybe reduce overall corporate debt. Other companies, Coca-Cola is a great example of this, is that they consistently have regular income due to profits every quarter, and so they'll distribute that in the form of dividends to their shareholders. So it really depends on like the culture and the climate that a particular corporation has with regards to what to do with those proceeds. Debt securities, this is borrowing through debt instruments such as a bond. Bondholders have priority over stockholders if there's an insolvency issue. So previously we've discussed bankruptcy. So shareholders, obviously they're in line if a corporation goes through bankruptcy proceedings, but because a bond is considered a debt instrument, they have priority over shareholders. Equity securities, this is where you actually take an ownership stake in the company, usually, and for what most people understand, is shares of stock. So stock gives shareholders legal rights in addition to ownership. They have a share in earnings if earnings, obviously, if there's profits to be earned. Transferability is a very key aspect of equity securities because you can buy and sell shares of stock. Private equity is a little different in that, this usually involves small startups, and so, as an option to try and raise capital, private investors, usually what they're looking for is some sort of interest in the company. So you could have like venture capital, which, a lot of times, these private equity lenders, they require higher rates of return because of the investment risk. There's also another type of example which is listed here, which is referred to as leverage buyout. That's usually where financing is utilized in the acquisition of another firm. So this is where you're not usually relying on open markets like you might be in the form of equity securities or traditional open debt markets in the form of debt securities. These are very targeted types of investment services for corporations. When we talk about corporate bonds, always know that bond is a debt security. So that's essentially, it's a financial instrument. It's an agreement promising to repay a certain loan of money. So like an IOU or maybe like a promissory note. Usually there are periodic interest payments, sometimes in the form of coupon payments to whoever the bond holder or holders are. And then usually there is a lump sum that's due at some designated future maturity date. So they could be, a period of 1 year, 5 year, 10 years, whatever is agreed upon between the corporation and whoever is the issuing bond authority. There are two broad categories of corporate bonds. There are indenture bonds and debenture bonds. Indenture bonds are secured to specific corporate assets and usually administered by a trustee. And so, if in today's world, in terms of access to capital markets, indenture is a preferred form because there is an asset that your debt is being specifically tied to. Debenture bonds are unsecured promises of a corporation, and they're not tied to any specific asset. Rather, they are tied to the reputation of the company. And again, if you're talking about a company like Amazon, obviously they have a fairly pristine reputation, but a lot of times they may not need bonds to begin with because they have an abundance of cash reserves. But new startups or smaller to mid-sized corporations, it may be harder for them to get a debenture bond, and it may be actually that it would be tied to a specific asset in order to secure that funding. So that would be an indenture bond. So I know they sound alike, but just remember, indenture is tied to an asset. Debenture is not tied to a specific asset in the world of bonds. When we talk about corporate stocks, stocks reflect an ownership of a corporation, and shares that have been issued to holders are termed outstanding. So if we're talking about outstanding shares of stock, stocks usually are kind of grouped together in some broad categories. It could be common stock, which is usually ordinary stock, and that's what most of us are familiar with when you think of stocks that are traded on the open markets. Preferred stock is also traded openly, but the benefit of a preferred stock is that there's priority over common shareholders for dividends and distribution purposes. So usually, I shouldn't say usually, I think almost always, I haven't really seen an instance where this isn't true. Preferred stock does come at a premium price, but there are benefits to that. It's almost like a preferred or premier class of share ownership. Initially, when stock is valued, and there's a complex accounting process that determines initial valuation, that is listed as the par value. Book value is based on company assets, so what are the actual assets that are on hand that belong to the company. Market value is what fluctuates as soon as shares of stock are sold and they go out onto the open markets. So like, let's say, the New York Stock Exchange, market value is what fluctuates, from day to day, from hour to hour. So just kind of have an appreciation for the different ways in which shares of stock are valued. The par value is what is that initial, usually public offering, and then market value is what will fluctuate. It'll either go up or it'll go down. So common stock, as I mentioned, that's just ordinary stock. It has no preferences, but for holders of common stock, you're allowed to participate in the control of the corporation. Usually you get one vote per one share of stock. So the more stock you own, the more shares you're entitled to in terms of the voting process. You are entitled to share in the profits which are in the form of dividends if the company issues dividends. They don't have to, but again, in the world of investing, if you're looking for companies, there are companies that have a commitment to regular dividend distribution, and that's part of kind of like an incentive or a lure to kind of encourage investors to buy their shares of stock. Also, as a common stock holder, you can participate upon dissolution of the company in the distribution of net assets. Again, you have to satisfy all outstanding debts, which includes bondholders. So, again, like when we talked about bankruptcy, in the world of like creditors, it's like you have secured and unsecured, and it's like, well, shareholders, they do reflect an ownership interest in the company, but depending on the company itself, it's like, well, if you have a lot of debt, you may not see dollar for dollar a complete return on your investment. Preferred stock, again, as I mentioned, has priority over common stock with regard to distribution of dividends and or assets upon liquidation. So I've seen cases where companies will issue dividends to their preferred shareholders, but not their common shareholders. So again, that just reflects a priority status that preferred has. Shares can be acquired of preferred stock through what's called subscription of an initial issue. So that's essentially a contract to purchase a specific number and kind of shares as they are issued by the corporation. So you kind of like pre-agree that as additional shares are going to be issued, you will buy either a certain number or maybe a certain percentage of those shares. Regarding stock transfer restrictions, normally, we don't like to kind of infringe on that, but if it's reasonable, then they can be considered legally valid. Normally, restrictions have to be apparent on the stock certificate or known by the transferee, the party that's acquiring it, in order for it to be enforceable. So, like, that might be a condition that has to be made known to the person who's purchasing or acquiring the stock, that there are some sort of stock transfer restrictions. Initial public offerings, this is when a corporation actually is starting up, and all IPOs are governed by the Securities Act of 1933. And so, normally there's like these stages or steps that are involved, and I kind of have them listed here 1 through 5. So, maybe a company wishes to raise money through some sort of private equity, and then they can do this through selling stock. They usually require the use of an investment bank, and that bank agrees to underwrite the sale, and then they get a fee or a percentage of what is being transferred in this initial IPO process. The company then prepares a registration statement that contains details of the IPO. Once it's approved by the Securities and Exchange Commission, because it does have to be approved, then the investment bank buys shares, and then they'll kind of like release them on the open markets. And companies can issue additional stock in the future, but these are not referred to as IPOs. So IPOs is this initial process for a new company. This is just some kind of examples of the potential like value of, when you're considering different types of business entity forms. Corporations usually have a greater ability to tap into capital markets in order to raise money. And so, if you want to be a sole proprietorship or partnership, obviously you have greater control. The downside is that you probably have less ability to raise funds. With corporations, you have the ability to maybe lose control of the company because it's owned by whoever owns a controlling interest or share of the stocks that are existing, but you have a lot of ability to raise capital. So like with everything in life, there's always these trade-offs, pluses and minuses that exist. Dividends is a share of the profits. So assuming your company is profitable, then that's the ability of a company to kind of share those profits with their shareholders. Again, they don't have to do that. Dividends can be in the form of different types. There could be a cash dividend, so that's a set amount of money per share that's distributed to shareholders. That's usually the most common. That's what most people think of when they think of a dividend. It's a cash payment. To give you an example, I own shares in Coca-Cola, and Coca-Cola is an example of a company that every quarter, based on the number of shares you own, you will receive a cash dividend that's dropped into your market account. And they're very consistent, very diligent in doing that. That is an incentive. For me as an investor and other people that purchase stocks like Coca-Cola that do issue regular dividends, that's the lure. It's like it's a form of income in addition to hopefully the stock value going up over time. Dividends can also be in the form of what are called, they can be stocks. So shareholders are given a percentage of a dividend in the form of a stock. That's usually the second most common. Property could be given in lieu of cash. That's usually rare. That's not a common thing that could be issued. And then another aspect of dividends is that instead of it being cash or stock, you could do what's called a stock split. And stock splits, if you look at this chart, this is, I'm not trying to sell Coca-Cola stock here, but it's just a great example. Companies, as they grow, they can split their shares of stock. Apple just did it, in 2020, in mid-year 2020, they did a 4-to-1 stock split. And I think back in 2014 or 2015, they did a 7-to-1 stock split. So what happens with stock splits is that, let's say you own 100 shares. And let's say that, the corporation issues a 2-to-1 stock split instead of an actual cash dividend. So they're doubling the number of shares that exist. And so your 100 shares would become 200 shares. And so normally what happens, sometimes corporations want to try and, kind of like modulate or control their share price. And so by issuing a stock split, that's a way of lowering the value of your stock. If it's a successful company, you can see like here in the chart with Coca-Cola, the share price drops, but you're doubling your shares, so you're not really losing value. And if it's a good company, it'll go back up, and then over time they'll probably issue another stock split, and then it'll go down, and then it seems to go right back up again. So it does kind of, it has the effect of augmenting your value and increasing the number of shares, even though the price does kind of like half or more sometimes, depending on if it's like a 2-for-1 split, 3-for-1, or so on. Now, I've seen firsthand experience companies that do a reverse stock split, and companies do this to try and boost or push up their share price. So you would have, let's say, if it's a 2-for-1 reverse stock split, if you have 100 shares, you now only have 50 shares. But hopefully the goal is that it's pulling the value up because you have less shares out there. Again, I've seen that happen, and I've also seen that not work so well. So, it just kind of depends in terms of that strategy. The law does impose some limitations on cash or property dividends. So if the business is insolvent, if paying dividends would make the business insolvent, or if payment would represent would violate a restriction, I should say, in terms of what the articles of incorporation require. So those are usually the only kind of restrictions or limitations that the SEC can impose on the issuance of dividends. Otherwise, usually shareholders like dividends because it's kind of like it's a form of income. The more shares you own, the greater the dividends you can receive. It really just depends. Some companies, in lieu of dividends, they'd rather just plow back that money and kind of invest it in R&D and reduce debt or expand their operational capacity. So again, every company is a little different. Anyway, I hope this helps kind of better explain some sources of corporate funding. As you have questions, please feel free to message me anytime, but have a good and productive rest of the week, and I'll be chatting with you all online. Thank you so much.